gold to find support somewhere around the most critical level is going to be about 3,300 for gold, warning us and saying, hey, this is a major blow off top phase, finally puts in a bottom, builds a base, and starts to turn up again. And so we don't want to be in it. I'm not in gold. Silver is the highly speculative play. If gold turns up and the precious metal space is on fire, you pretty much want to own silver. It's kind of the fastest, one of the top movers. It's very dangerous, it's very speculative. It wipes out its gains very quickly. As much as I always say, be very cautious with it, it's very dangerous to trade. It's what I own the most of. This is the first time in decades I haven't held physical metals. I sold it at a premium. I'm looking to buy it much cheaper. And I only want to buy it once it's finally put in a bottom, turned a corner, and starts to go higher. You might as well move to something that's going to generate a return. And the stock market at this point is still one of the better positions to be in until it starts a downtrend. Whenever you get a whole number like 4,000, 5,000, 6,000, or lower, it could be 3,000, people naturally buy at those levels.
You mentioned gold, Chris, and you said that you see it as going into bear market now. So is that a relatively short-term bear market, or are you getting bearish for mid or long-term as well?
It's hard to tell how long like a bear market will happen, right? Like in 2008, the bear market was very short. It was like 8-9 months kind of from where it took off, where it really started to break down and collapsed. If you go back to the 2000 bear market, it took 3 years for the bear market to unwind. So you never really know how quickly something's going to unwind. What I like to follow are key levels. Like right now, we're looking for gold to find support somewhere around the most critical level is going to be about 3,300 for gold. And the big question is, does it hit that in the next month or two and stabilize while the rest of the world falls apart? Or is it going to slowly kind of drag out, kind of like what it did back over here in 2011, we saw it peak out, and then eventually it broke down, but it had a slow grind that it just kept going lower for several years. And so, I mean, that could be the scenario again. We might actually see gold just slowly grind down for a few years while the stock market and everything kind of cracks and the dollar rallies. So it's hard to put a timing on it.
This setup resembles previous turning points, but timing, not headlines, usually determines who preserves wealth. According to Chris Vermeulen, history shows bear markets can unfold over months or years, making rigid forecasts less useful than disciplined trend analysis. Investors focusing only on price targets often ignore broader shifts in dollar strength and capital flows that shape every cycle. Waiting for confirmation may feel uncomfortable, but chasing every bounce has historically been far costlier. Next, Chris Vermeulen exposes why support levels alone can mislead investors during major trend reversals.
I thought the stock market was going to time a long time ago, a couple of years ago. I thought it was going to top out, but it hasn't. It keeps going up, and we have to keep riding this market higher and until it does change direction. So that the key is not to predict and try and figure out when it's going to do it. It's just to understand that eventually it will have a big correction, and you need to identify when the trend has changed and then how to either avoid the correction or how to benefit from it.
Right. So at this moment, Chris, you don't think the risk to reward would be on gold side, and you wouldn't really want to be involved in that sector at this moment until it sort of plays out and gives you the sign which direction it wants to go, right?
Right. Yeah. So we closed out our physical gold position just above 5,000. We also closed out our silver position above 113. That was a major cycle. Everything was warning us and saying, hey, this is a major blow off top phase. We closed it out, and we're looking to reinvest sometime in the future when it finally puts in a bottom, builds a base, and starts to turn up again. And so we don't want to be in it. I'm not in gold.
Missing a rally hurts less than riding a collapsing trend all the way down. And Chris Vermeulen notes that protecting capital sometimes means holding cash instead of forcing exposure when risk outweighs reward. Wall Street often celebrates staying invested, yet professionals regularly reduce positions when probability shifts against them. For long-term savers, avoiding a major drawdown can matter more than capturing the final percentage of a mature rally. Next, Chris Vermeulen reveals the overlooked signal he believes confirms when institutional buyers are finally returning.
This is the first time in decades I haven't held physical metals. I sold it at a premium. I'm looking to buy it much cheaper. And I only want to buy it once it's finally put in a bottom, turned a corner, and starts to go higher. I want to catch it for the next move up. So I'd be very, very cautious in this space. You could lose 5 or 10 years here in precious metals with no return and really just waste a lot of time. And time is money, especially you could put your money into a simple savings account and make more money than you will holding physical metals, right? Because metals actually cost money to hold. And if they're not going anywhere for several years, you might as well move to something that's going to generate a return. And the stock market at this point is still one of the better positions to be in until it starts a downtrend.
Yes, and if we look at the recent short-term actions in gold, Chris, are you seeing maybe some small indications that 4,000 could be a certain base and a certain support level?
Yeah, there's no doubt it is a short-term support level. Just looking at the chart, we have this 4,000 level from last year. So we have this kind of breakout in this support level. You carry that through, and that is where it has found support. It's a previous support level. It's also a whole number.
Many assume holding gold forever is always the safest strategy. Yet every cycle challenges that belief. What Chris Vermeulen is highlighting is that preserving wealth sometimes requires waiting instead of remaining permanently invested. That clashes with the popular narrative that every dip deserves immediate buying regardless of trend. Patient investors often outperform emotional ones because opportunity cost quietly compounds while stagnant assets consume valuable time. Next, Chris Vermeulen unravels why psychological price levels can become traps instead of protection.
Whenever you get a whole number like 4,000, 5,000, 6,000, or lower, it could be 3,000, people naturally buy at those levels. If price is above it and is falling towards 4,000, there's just this natural bias that people are like, if it hits 4,000, I'm going to buy it. It looks like a good level, right? And I see that all the time. I've had a ton of people saying, you missed the bottom. It was at 4,000 and it got a beautiful bounce. I'm like, it's just a pause. It's an emotional level where buyers step in. And right now, gold is in a bear market. The odds are it's going to go back down to 4,000. It's going to eat through all those people who keep buying and accumulating there. Then it's going to break down. And it's going to keep going down. You're buying something in a downtrend. It's a very dangerous play. It's not, to me, it's not smart investing. I don't average down. I don't buy something in a downtrend. I wait until it breaks out and until it's in an uptrend. So yes, it's a short-term support level. It has found support there. It's bounced, but it sure doesn't look very healthy. And to me, it's going to have another 15 to 20% correction from where it is and sell off. So that's all it is a technical support level, short-term, within a downtrend.
Very interesting. And just one quick question on silver. Do you, Chris, still see silver as pretty much a leveraged play on gold at this moment?
The levels everyone is watching often become the easiest places for investors to get trapped. Chris Vermeulen's argument suggests that round numbers attract emotional buying, long before genuine accumulation returns. Institutions frequently wait until retail conviction is exhausted before committing meaningful capital. Protecting wealth isn't about buying what feels cheap. It's about recognizing when probability finally shifts back in your favor. Next, Chris Vermeulen reveals why silver's reputation as leveraged gold carries hidden risks most investors underestimate.
I do, yeah. Silver is the highly speculative play. If gold turns up and the precious metal space is on fire, you pretty much want to own silver. It's kind of the fastest, one of the top movers. It's very dangerous. It's very speculative. It wipes out its gains very quickly. As much as I always say, be very cautious with it. It's very dangerous to trade. It's what I own the most of during this rally. I held about 65% silver. And of course, that's simply because it has the most upside potential. On the flip side, I had a lot of gold because I like the stability, the slowness, the predictability of gold. So I had that mix. I do love silver. I made a ton of money on this recent bull market in silver. And there's going to be another time to be in it again, but it's speculative. You only get in when it's on fire. You don't hold it when it's, sinking a sinking ship.
Yes, 100%. What about mining stocks, Chris? Something like GDX. Is it looking also quite bearish in your view?
It is. It's put in a high volatility top. 150-day moving average is now sloping down, telling us we're in a bearish environment. It has a series of lower highs, a series of lower lows, which is the definition of a downtrend. The moving averages are sloping down.
Retail loves silver's upside, but professionals obsess over managing its downside first. This is where Chris Vermeulen's thesis shifts from bullish enthusiasm toward disciplined timing instead of permanent ownership. Mining stocks and silver frequently magnify both gains and losses, making trend confirmation far more important than conviction alone. Preserving capital during volatile cycles leaves investors prepared when genuine institutional demand finally returns. Next, Chris Vermeulen exposes why waiting for trend reversals may outperform buying perceived bargains.
You really don't want anything to do with the precious metals space at this point. You really want to wait for a huge capitulation, a big washout low, a sell-off. We're going to see one of two things happen, right? We're going to eventually see gold, silver, and miners have a huge sell-off and crash. We'll see volume probably spike up. It'll put it in a low, and then it'll start to put in a rally and turn a corner. It'll go from a downtrend to an uptrend. Or we're going to eventually see it stabilize, build a base, and eventually when it breaks out of that base, it'll be a new opportunity for a new trend going higher. I don't care if I buy gold and silver at a higher price. I just want to know when I buy it, it's going to be moving up on average every month. I don't want to, hold it if it's going to keep going lower. So all I'm looking for, I'm not looking to specifically buy it lower at a lower price. I'm looking to just buy it when it starts a new uptrend. And that could be at a much lower price. It could be at a much higher price. Either way, when I put my money to work, I want it working for me. I don't want it just sitting there, with a lot of downside risk and underwater and not generating any return.
Makes a lot of sense, Chris.
Buying lower means little if the trend keeps working against your capital for years. According to Chris Vermeulen, the real opportunity begins when momentum confirms a durable reversal, instead of guessing bottoms. Many investors confuse lower prices with lower risk, even though history repeatedly proves otherwise. Wealth compounds faster when capital follows established trends rather than fighting them. Next, Chris Vermeulen reveals the broader market conditions he believes must appear before precious metals truly recover.
Right. And would you expect that to bring the real estate market down as well? I think the last time we spoke, we had a look at the real estate chart as well.
Yeah, real estate is still doing pretty well. It's holding up while the stock market has been selling off and going down. Like the NASDAQ, we've seen real estate go up. In fact, we hit a target on our IYR position about a week ago as it spiked up here, hit one of our first targets. And I like real estate. I like utilities. They are defensive plays. Real estate's interesting. Well, to quickly answer your question, I do believe eventually real estate's going to get hit very hard. Interest rates are going to go up. We're going to have a financial crisis. We're going to see stocks blowing up. People lose their net worth. I mean, their wealth, their account sizes. It'll trickle through to real estate. But right now, real estate is still actually kind of a hot commodity, or it's holding up better than other things, because when people who buy into growth stocks and technology, when they get nervous and they start to sell, they go to what they know best. And everybody is brainwashed, which I wouldn't say it's wrong, is that real estate is a very good investment. And so they naturally go to like IYR to buy real estate. This buying an ETF, a real estate ETF, is not the same as buying real estate.
Strong real estate prices can mask growing financial stress beneath the surface. Chris Vermeulen notes that defensive sectors often attract money before broader economic weakness becomes obvious. Investors frequently mistake temporary inflows for permanent strength, overlooking how rising rates eventually pressure property values and household balance sheets. Protecting wealth means recognizing when today's safe haven becomes tomorrow's vulnerability. Next, Chris Vermeulen exposes why real estate ETFs and physical property behave very differently during crises.
This ETF can cut in half by 50 to 75% in a bear market, so you have to be very cautious, whereas real estate generally won't do that, real physical properties. But right now, the short-term movement is into this space. People are moving in, and it looks like it wants to have another leg higher. I think we could see real estate push up for one more little push.
But ultimately, Chris, once the trend changes, would you expect, to see normalization of valuations that could look something similar to what we have seen in 2008, meaning a crash style event, or like so how are you viewing it from the risk side if you look at the stock market?
Yeah, well, I do have a very bearish outlook. There's a lot of things coming together that we need to be aware of. Right now, we're seeing major turning points. I do believe, to answer your question shortly, in a point answer is yes, I do believe we could have a very big financial crisis. Evaluations get back down to really low levels where things are actually undervalued, and to me, that's actually fair value. That's like where we want it. But when we look at the markets, we have major asset classes turning some major corners. So, for example, let's go and take a look at the dollar.
Markets can appear resilient right before valuations reset far faster than most investors expect. What Chris Vermeulen is highlighting is that short-term strength in real estate doesn't invalidate mounting macro pressures across multiple asset classes. Retail investors often confuse delayed reactions with immunity, while institutional capital quietly prepares for changing conditions. Ignoring those shifts can turn perceived safety into unexpected portfolio risk. Next, Chris Vermeulen unravels why the dollar may become the market's most important warning signal.
We'll just go to the weekly chart of the dollar index. The dollar is a very good indicator, barometer of kind of what's unfolding. And if we look at this chart, these are the key pivot points we need to look at. So the dollar created this bottoming formation over the past year and a half, 2 years. It's broken out. So the dollar has turned a corner and it's starting to rally. If the dollars rally, we're usually seeing stocks start to weaken. We're usually seeing the economy and global economy start to weaken. We're starting to see fear creep up. And so I believe we're going to see the dollar here really take off. This is telling us things are changing dramatically. Now, if we go and take a look at the precious metals space, precious metals put in a major top, a signature euphoric blow-off phase, topping pattern. It's selling off. We now have gold actually in a bearish trend. If we go back to the daily chart, the 150-day moving average has now topped out and it's moving lower. All of the moving averages are like sloping down and layered below it. So we have the dollar in a new bull market. We've got precious metals, gold, silver, and miners all now in a new bear market. So there's a major trend reversal coming, and we're seeing sector rotation where money flows into one sector one month and then out of it the next. We see memory stocks, we see utilities in another month, we see AI meta stocks do well.
When capital quietly rotates, headlines usually explain the move months after institutions have acted. Chris Vermeulen's argument suggests the strengthening dollar may be signaling broader stress before consensus fully recognizes it. History shows sustained dollar rallies often coincide with tightening liquidity and pressure across risk assets. Investors watching only gold prices could miss the larger macro transition already underway. Next, Chris Vermeulen reveals why sector rotation may be masking a much deeper market reversal.
We see semiconductors, we see cybersecurity. Money doesn't know where to go. It keeps going all over the place. So when we look at it from a big standpoint, it really is the market is at this very critical junction. It keeps getting weaker and weaker. Now, the trend is still up, but we got to be aware of these critical levels from the June lows that we saw in the stock market. If they're broken, then we could really see this huge reversal. So there's a lot going on. And if this unfolds like I think, this would trigger a multi-year kind of bear market and correction, which would bring the evaluations down to kind of maybe not the same as 2007, 2008, but it'll definitely probably cut the valuations in half or more. And we're going to see some very sharp corrections. So I think it's a great opportunity. I'm not saying it's going to happen. The charts are starting to point to that. A couple other things really to touch on. We're seeing the war pick back up with the Strait of Hormuz. We're seeing crude oil skyrocket and start to shoot higher. Inflation is now a major concern as oil shoots up and war takes on. we're going to see interest rates start to go higher. And if we look at the interest rate chart, interest rates, especially for the 30-year, is over 5% now. When we look at the interest rates, this is the other major equation that really we don't want to see happen, but it's possible it's going to happen, and it will trigger a massive financial crisis.
Markets often look healthiest just before liquidity begins disappearing beneath the surface. This is where Chris Vermeulen's thesis shifts from isolated chart analysis toward interconnected macro risks spanning energy, rates, and equities. Wall Street tends to celebrate sector leadership, while overlooking the growing fragmentation underneath. For wealth preservation, recognizing weakening market breadth matters more than chasing whichever sector rallied last week. Next, Chris Vermeulen exposes the overlooked interest rate trigger that could accelerate systemic stress,
which is the 10-year, the 30-year, like all of like the interest rate charts are pointing to very high interest rates. Now, if they don't have to get to these levels, which is like 8%, but if interest rates keep pushing higher, it is going to cause a huge problem. As rates go up, bonds go down, and TLT is a perfect example of that. We're seeing bonds, it's hard to see on this chart, there's a lot on it, but TLT, the price of bonds are testing major lows and is on the verge of breaking down. A ton of investors hold bonds. They play the actual price of bonds as an investment, but they might actually see a very sharp drop here. And so there's a lot of things turning. The dollar, precious metals, interest rates, the bond market is on the verge of breaking down, another major leg. It's going to devastate a lot of people. So, I mean, that's the super bearish outcome. Obviously, if this market can hold up and pick up traction and there's some new wave of energy and money to flow into the equities market, we could see it go higher. But right now, it's play the bullish phase until it changes direction, and then make sure you have a game plan to benefit from all of these major trends that are going to be starting going forward.
Yes, and given how leveraged the system is, higher interest rates could be very, very problematic.
Higher interest rates don't need to reach extreme levels before financial cracks begin spreading. According to Chris Vermeulen, weakening bonds, rising yields, and a stronger dollar together form a combination investors should never dismiss lightly. Markets rarely announce systemic stress in advance. They reveal it through converging signals across multiple asset classes. Those ignoring these warnings may discover diversification offers less protection than expected.